to all of you. So here we are, Dhruthi and me, speaking to you from a wonderful place called Heaven's Ledge. So the entire Hexagon team is out here on our annual retreat. And I think it's an amazing place for us to be speaking to all of you from. And it's been a crazy, crazy week. I've never seen a week packed with so many developments. We've had our own union budget. We have had the European Union free trade agreement. We've had the US-India trade deal. And we've had the Monetary Policy Committee meeting today. And wow, and markets have globally are in a tizzy. That's a whole lot of things for us to talk to you about today. What do you think, Dhruthi?
Yes, of course. I mean, let's start with actually talking about how Anthropic AI is causing a bloodbath amongst tech stocks globally and in India as well.
Yeah, that's true. I mean, this thing has always been hanging over our heads about what AI is going to do to the software industry. And I think everybody knew about it, but we are sort of kicking the can down the road. And it's actually happening now with the Anthropic CEO coming down and saying that they have a new model which can write code so easily. It is freaking investors and software companies out of their wits. And we've seen what has been called the software meltdown, okay? Softmageddon, or whatever they call it. And we've had Indian IT companies, US companies, software companies across the world, shares falling by 10%, 15% on an average. And apart from what AI has been doing to the software industry, we've also had the issue of the biggies announcing their capex budgets for the year. By biggies, I mean the Mac 7, the Mac 10 types. And the huge allocations to new data centers continues. And they're all like $100 billion, $150 billion. And they speak about it as if it is loose change. But finally, even last year, there were a lot of concerns about this kind of capex budgeting by the big seven. And the real worry here, friends, is what are the kind of returns it is going to have. All these years, these companies have been enjoying a massive free cash flow and high margins. And the moment these free cash flows get diverted to infrastructure, your margins are going to come down. And the period of ROI is going to go up, and your free cash flows are going to suffer. One of the reasons these companies have been having a premium in their price earning multiples is because of the high free cash flows. And if that is going to suffer, then stocks could likely fall with a derating, as we call it. And that's what is happening now. But things are so speculative and so uncertain. One cannot rule out how the short-term price behavior is. So while these issues are there are a whole lot of other things weighing on investors' minds, like the investing away from USA concept that has been ruling the roost. And the last few months, since I think October or so, institutional investors have been moving away from US and directing incremental flows into non-US stock markets. So this also could be there, and it just takes a trigger for things to accelerate. And it could be the capex allocations could be a trigger. The Anthropic's announcement could be a likely trigger. We never know exactly what is that final nail in the coffin that's going to make things. I mean, coffin is a very pessimistic term to use. I don't think things are so pessimistic. But yeah. And along with this fall in stocks, what else has fallen?
So what else is falling? I mean, you name it. We have commodities, bitcoins. The last week has been crazy. So we're seeing the US dollar index at a 2-week high, and this was after it hit a 4-year low. So people have been selling off their gold and silver holdings. So we've seen about a 24% fall in silver on the last week, and gold is corrected by almost 5%. It initially started off because Trump nominated Wash as the next Fed chairman, and now people are just panicking, and whoever have a lot of allocation in commodities like gold and silver, they've been booking profits.
A lot of investors have been on leveraged positions, so they're much more sensitive to bad news. They're much more sensitive to price falls, and any pessimism, any doubt can trigger a large movement like this because of huge number of leveraged positions by investors. The dollar index has gone up and why did that happen? You've had stocks falling, you've had Bitcoin falling, you've had gold and silver falling. So investors tend to go to a safer asset, and that was a US Treasury. So whenever you have risk assets falling, you have safer assets going up in value. So since the yields on US Treasuries are looking attractive at this point of time, you had the dollar also strengthening. Okay, so dollar is also a safe haven asset. So when everything else, given whatever you may speak about de-dollarization, when something bad happens, investors still go and tend to flock to the dollar. That is one thing that has been happening. Liquidity concerns which have been there in investors' minds, it's only a projection. We don't know anything yet till the actual policies come out after the new nominee comes into play. So the long runway, and your markets could very well yo-yo in between. As far as oil is concerned, okay, many times it seems that Iran may not get attacked, and at times they feel that Iran will get attacked. And these are what are determining oil prices. When people think US is not going to attack Iran, oil price falls, and other times oil price goes up. So absolutely no predictability on these issues. Same with gold and silver. One has to just let it be. And if you want to accumulate precious metals for the long term, dips like this could keep happening during the year. Use them, as many of the fund managers say, to accumulate your position in precious metals. And we've also seen US-India trade deal happening. We also said that once the trade deal happens, that could be a trigger to Indian markets, because Indian markets have been just going around, not really doing much, while other emerging markets have been doing pretty well, actually. They've been the star performers last year. India has been bottom of the pile. And we've had the EU free trade deal happening, right? Can you just tell us about the salient points of these two trade deals?
So this was a big one, a lot of exciting things happening. So almost 90% of the goods that are being exported to India from the Europe are seeing a reduction or removal in terms of tariffs. We've seen huge reductions from almost 110% to 10%. And about 800,000 jobs are, dependent on these exports. And this number is expected to go up post this deal. And some of the sectors that are, impacted by this, we have, food products, chemicals, machinery. Machinery saw a huge reduction, almost 44% in tariffs. We saw chemicals, which was down 22%, and even pharma, which was about 11%. So we're expecting the bilateral trade between these two regions to improve by 40 to 65% in the near term.
Eventually, we are hoping that the foreign institutional investors come back into the country, bring the dollars in, take the stock markets up. It's yet to happen. Let's hope it happens, because domestic investors continue to repose confidence, continue to buy Indian equity markets. Again, only time will tell what would happen. Couple of impacts of the Indian budget itself. Again, I think we should stop thinking of the budget as a time for fireworks. Reforms are happening through the year, not necessarily during the budget time. The budget is a time for arithmetic and maybe sometimes new policies to happen. The budget has been mostly predictable. A lot of allocations have been made to sectors to boost manufacturing, to boost employment. Let's see how that pans out. Fiscal deficit coming down, no concern there. It's following the glide path. Borrowings have gone up. The budget does talk about a higher level of borrowings, around 16 lakh to 17 lakh crores. And that has made the bond markets a little nervous. And the long-term bond yields have gone up because of this. Needs to settle down. And I'm sure in the meanwhile today, the RBI's MPC, Monetary Policy Committee, is meeting and they will come out with a policy. We don't expect any change in interest rates, but let's see what they talk about liquidity in the Indian market, because liquidity in the Indian bond market has been low. And this has resulted in short-term corporate borrowings to become costlier. Interest rates on short-term corporate borrowings have gone up. And for short-term investors, there's a good opportunity out there as compared to G-Secs. Beyond this, I don't see anything that is really impacting the stock markets much. there's been one change in taxation, right?
That's right. So just two things actually that I wanted to mention from the budget that will probably is important for your portfolios. One is the increase in the securities transaction tax, which has gone up to about 0.15%. It's almost doubled actually. And the second point that I would like to mention is that how the SGBs will now be taxed. So as you know, there are no fresh tranches of sovereign gold bonds anymore, but whatever you buy from the secondary market will now be subject to capital gains tax.
Yes. So what they were saying is, if you bought these bonds during the primary issue and you wait till maturity, the whatever gains you get are not going to be taxed. But there was no clarity about what people about if you bought them in between and then held on to maturity. This budget has made it clear that if you happen to have bought these sovereign gold bonds in the secondary market and you hold on to maturity, you will not be eligible for the capital gains tax exemption. So please be aware of that. The securities transaction tax went up, as Dhruthi mentioned, to 0.05% from 0.01. That's a huge increase, but this is only applicable for F&O transactions, derivative transactions, not your equity cash market transactions. This is entirely meant to reduce speculation. As SEBI kept on saying, we've become like one large casino. The quantum of derivative transactions is many times that of the cash market, which is not the case in many other developed markets. So possibly in India, we've seen excessive speculation. It's a good thing that they bring it down, give some stability to the market. But also do remember, it is speculators who give liquidity to the market. And because of which also markets fell a bit, because the amount of speculation is going to come down because of higher transaction costs. And so, there was this article that I forgot to speak about in Times of India a couple of weeks ago.
That's right. So something interesting that we came across last week actually. So parents have actually been saving up for their children's education, and the fact that rupee is depreciating at such an alarming pace, they've been cancelling their plans. And, it doesn't matter if they've been planning this over 5 years or even a decade. This is where financial planners like us can actually help.
It's sad to see students having to cancel their program to go abroad, because this would have been a dream, and shattered only because these programs became more expensive to them, and not because the fees went up. It's because the rupee went down. Okay, and you had to spend more rupees to get the same number of dollars to pay for the college fees. As Dhruthi said, financial planners like us really come into the picture to make goals happen, to make dreams happen, because we know this is going to happen. We know rupee is going to depreciate, and we factor it into your SIP, into building the corpus. So the rupee has really not depreciated more than what we thought it would over the long term. So anybody following a proper financial plan that factors in inflation, that factors in rupee depreciation, would not have had to suffer. So never ever underestimate the power of good financial planning. Okay, and we've had some questions come in from our viewers. I think at least a couple of them we can tackle today. And one of the questions asked rather, how does this year look for the equity market in India, and what is it that we can expect? When the question came in, the US trade agreement had not happened, and I would have probably answered at that time, things are going to be so-so this year, earnings are not growing much, and if the trade deal happens, that would be a trigger. But here we are, the trade deal has happened. Has our view changed? Still remains uncertain. Okay, what is bothering us now? The foreign investor has to come in and provide that additional boost to the market. The domestic investor is already in. We need another pillar. Let that happen. Okay, and they're also going to be looking at fundamentals very closely. Are we seeing something that is going to boost earnings growth? Actually, the Q3 results were better than what I hoped, and if the trend continues, we may see more positive action from the Indian markets this year. I'm quite reasonably confident that the markets will generate a positive return today, unless something hits us from the side, which we are not seen at all. The other question was from an NRI, okay, and he's asking what should be the ideal asset allocation for an NRI between debt, equity, Indian assets, foreign assets, real estate, so on and so forth. It's a typical query, and for any financial planner, advisor, it's not a difficult question, but it's a big dilemma for many investors. Okay, what I would say to this gentleman is this: the broad allocation between investments in the country that you're residing and India should be like this. Wherever you are residing, that is where the majority of your savings and investments should be, unless it's an unsafe country. Okay. If it's a safe country, that is where you're living, that is where the majority of your holdings should be there. Maybe 20 to 30% of it can be invested in other nations. India being the best of them because you're familiar with India, and India is one of the largest and quickest growing economies in the world. So it's worth having a large component of your investments in India. The second thing is between debt and equity and real estate. Okay. So if you're having a large component of your investments well allocated in your home country with debt and equity, then for India, you can just go for equity. You need to be looking at the overall pie. And in the overall pie, you will be having an asset allocation discipline, how much debt and how much equity. And I think a portion of the equity can come to India. Real estate, again, is all about liquidity and illiquidity. You know you're not going to have liquidity in real estate. And if you're predominantly buying apartments, the growth is not going to be anything to write home about. Okay. So unless you want a home to live in, I don't really think that buying apartments is a great idea in India, at least. Equity is a good place to be in. Bonds only to dip into as a reserve, to buy equity as and when opportunities arise. This only if your risk appetite permits it, and if you're already following a particular asset allocation discipline for your overall investments all over the world. Okay. There would be times when equities are overpriced and then you need to be in debt. Okay. So these are complex decisions for you to take by yourself. I do think, honestly, they need a financial planner. They need an asset allocator, a licensed wealth manager to handle these kinds of questions for you. I think that's about it, folks. Let's see what happens in the rest of the week. Good day. Have a good time.
Good day. Thank you.